Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got a conversation with Chris. This has been a tumultuous week in the public equity and bond markets. A lot of the reaction stems from the way the Fed has changed its tune, moving from kind of this pessimistic, raising rates, slowing down the economy vibes, and shifting into something a little softer. We get into why that's happening and what it means. I hope you enjoy. Hey, Chris, you're in the UK, right?
I am. I'm 5 hours ahead of you, and just like I am in life usually, you know. I'm, I'm kidding.
Are you in London proper?
I am in Chelsea, 2 blocks away from the river and a very beautiful residential neighborhood.
I don't know London that well. We're going to go check it out summer of 24, but I've only been once, and it was a blur many years ago.
I'm gonna put it on live here that we need a London office.
Well, it's interesting because I know you're in London. And you just called it vacation, but you're working New York hours. So your idea of a vacation is flawed. We have to work on that. Right. So it's 5 hours difference. So what hours are you keeping?
Yeah, I go to bed at 3 a.m. and wake up at 10 a.m. local time, so that's 5 a.m. New York. Yeah, I don't even know. I'm losing track. But yes, like New York, full New York hours. My team's in New York and I have to do this. But I actually enjoy working. I know, a workaholic, but I enjoy working on vacation because it gives me a sense of security and serenity. I feel like I'm getting ahead without anyone knowing, and that's awesome. I'm a competitive person. What can you say?
Sadly, I feel the same way. I understand you. All right, no one wants to hear
Good.
about this. Let's talk about the markets.
Yep.
So what's happening
Cool.
today? Because this week has been a little wild.
Yeah, it's funny because we have these recordings on days that are just crazy volatile, and today just happens to be one of those. I remember we have one of our early recording this year on when SVB collapsed on the same day, and today is not of the same scale but close. One of those days that market as a whole experienced a 2 to 3 standard deviation move across interest rates and equity. What happened? Well, FOMC. So we had the last FOMC meeting of the year. Everyone was sort of holding their breath, waiting for Powell to come out and say something, because the last minutes that came out.
Can you remember to define FOMC for the mere humans?
Oh, that's the interest rate. That's what I've been talking about for quite a while now. It's the meeting where the Fed officials come together and set interest rates, and not just set current interest rates, but also provide future interest rate expectations. So dot plots. And yeah, so what happened today was, long story short, we had the minutes that came out about a month ago that fundamentally shifted the tone of the Fed. Up until that point, they were incredibly hawkish, meaning everything they say seem to say that data is not there yet. We need to continue to hike. About a month ago, when their statements got released, the tone shifted towards dovish, meaning they're now finally saying, oh, there's a chance we're actually going to hold and potentially cut. Okay. But nothing was confirmed until really a full FOMC comes around, which is today. And today, the gist of it is they did hold rates steady, that was not the part that moved the market. Everyone expected that. It's the sort of the statements, the comments that came afterwards. I'm just going to quote a few things that the Fed official, Chairman Powell, said. The biggest thing he said was further rate hikes are quote unquote not likely, but the possibility of hike is not off the table. Okay. And activity in the housing market has flattened out after picking up over the summer. And data suggested that the higher rates are slowing business investment, and U.S. economy overall is losing steam in the final month of the year. Okay. So those are the key comments. If you are following sort of what Powell has been saying for the past 2 years and, sort of looking for keywords here and there, this is the very first time he used sort of not likely when it refers to rate hike, future sort of further rate hikes. So this was taken as a massive win by equity investors, people who are betting on sort of the beta of the market to the overall economy, to equity market to sort of rally, because this was taken as a confirmation that there will not be any future rate hikes. Leading up to this point, the futures market was already pricing in sort of no rate hikes, but at least next year, people's expectations were somewhat conservative, meaning, there might be one cut and there might be by the end of the year, 2 cuts. Okay. 3, some, if you're really, really dovish. At this point, after today's meeting, everything just got blown out of proportion. So if you now stare at the interest rate market, the market that sort of, or futures market on interest rates, the market that predicts what might happen next year in interest rates. Now the market is pricing in a 50% chance of a cut in March. That's in 3 months from now. And a full cut in April. 2 cuts by May, 3 cuts by July, 5 cuts of 25 basis points each by the end of 2024. So that brings us down all the way from what's currently 5.25% to 5.5% from an interest rate all the way down to 4% by the end of next year, in the next 12 months. So that is a drastic move. And that is not, to be completely clear, that is not what the Fed officials said. Okay. Their median dot plot and what Powell indicated is still very much behind what the market is pricing in. So the market is leading the way here, and they think that at some point in the future, some Fed official will come out and readjust their statement even more dovish. So it's a crazy sort of dichotomy here and movement in one day. And if you sort of extend to the further part of the curve, the longer part of the curve, the 2-year treasury just traded down. So it rallied right on price, but yield went down by 30 basis points in one day. 10-year went down by 18 basis points. So now 10 years now back to 4%. Just about a month and a half ago, we're at 5%. So 100 basis point move on the 10-year in about 45 days. Again, this is sort of, the last time we saw something like this was really beginning of the cycle. So nothing like it for a while. That's just the interest rate market. Equity market sort of responded in a similar fashion, slightly less dramatic. S&P finished at 4,700, which is, I think, about a 1.5% away from all-time high. Okay, we're about a month ago, we're talking about potentially hitting 4,000. Now it's back to close to 5,000. NASDAQ still a little, about 8.5%, 9% away, which makes sense because tech led the sell off, and it's sort of leading the rally this year, but not where we were before. That's what sort of happened, right? Sorry for the long narrative, but that's sort of what happened overall in the market. Crazy stuff in one day, and fundamental shift in multiple ways.
I had heard someone talk to me recently. I talked to a lot of interesting people with different perspectives. Someone said to me that Biden is going to push through strategically a rate cut in Q1 because it takes about 6 months for that to ripple through the market and for the Main Street person to feel it. And that's good timing for the next election so that everyone's feeling wealthy when they go into the ballot box. Is that causality? Is that logic? Does that hold with you? I mean, I heard that and I was like, it sounds smart. Sounds plausible.
Yeah. Look, the Fed is supposed to be independent. And Powell has come out and stated this multiple times publicly that they do not respond to political pressure. But if you ask me, I mean, everyone's human, and it's almost impossible to shelter yourself away from politics when you're living in Washington, when you're living and breathing the air in Washington, and having politicians breathing down your neck left and right. So I would personally, my personal opinion, like I would not rule out the sort of, part of this push came from the current political party. But at the same time, they are adjusting to data, right? They can't make this type of move without the data support. So data is trending that way. Like I was just looking at BPI, right? The producer price index. That's sort of a leading indicator for CPI, which is the consumer side. It came out much weaker than expected about a week ago, right? We're at 0.9% year on year already. Remember, Fed's target is 2% inflation, right? Of course, measured by a different thing called PCE. But roughly, if you're seeing PPI at below 1% on a year-on-year adjusted basis, you can expect CPI to come towards that. in some time in the future. So data is moving that way. Inflation is coming down, as we've been talking about. But there are other mixed signals, right? Now, it's not all uniform. So labor market is still insanely strong. We're at 3.7% unemployment rate. And retail sales and earnings are still rising, although around the same rate as inflation. But when inflation comes further down and your wage continues to increase at the same or higher rate, your spending power goes higher, right? So that then feeds back to more inflation. So there's some mixed signals in the market where it says sort of this whole drama of inflation is not necessarily over as of yet, but the overall broader picture is trending that way. So the Fed has to act in accordance with data because that's just too readily available. Everyone's scrutinizing them over this. But on top of it, if you have a political party, the sitting president telling you, hey, you better, if you can, lean one way, it makes sense that they are coming out with, more dovish statements on the back of all of that. So yeah, definitely the possibility of it.
Now, we're talking about America here, and the world is wildly connected. I was in Dubai a couple of weeks ago, and the financial conversation was about what the U.S. Fed is doing, around the world. What is what does this movement in the market mean for other countries? Any particular significance? I mean, you're a third of the way around the world right now. Like, why does this matter for everyone else?
Funny you ask, because the U.S. is definitely setting the tones for the Western world, like overall, right? So likely you will see. We have already seen this, right? So Canada, UK, European Union, like countries that have close ties, trade relationship with the U.S., which are experiencing sort of similar, maybe slightly delayed inflationary pressure throughout this whole cycle, is now sort of all on pause in terms of hiking rates. So the U.S. is setting the way there, but definitely ahead of the pack. But if you go sort of a little further, right? If you go all the way East Asia, go to China, which has been experiencing deflationary pressure in the past few months, right? Not just disinflation. They're actually the price level is actually going down, not slowing down, but actually going down, right? So, and that's been happening for the past, actually on this one was 6 months now, right? For the past 6 months, every sort of month, data came out basically deflationary. And all these sort of, and that's, I don't want to get into that. That's a whole long conversation, but it's a lot had to do with the aging population, so slow recovery from COVID and a bit of a lagging effect, right, on morale and on with all the political movements that happen, and such sort of, slow, or sometimes in some cases very drastic, sometimes very slow adjustment in policy. For instance, in real estate, which completely just collapsed during COVID. Anyway, so China's going the other way. U.S. is sort of, relatively speaking, it's actually healthier on an overall economy basis, but it's setting the tone for the Western world in terms of pausing rate hikes. And all these things, right, ultimately come down to sort of the impact on currency and commodity prices. Currency, if just interest rate parity, for those of you who have heard it, but basically interest rate is one of the most fundamental drivers in currency value. And when a currency has low interest rate, you basically attract less foreign investment. Therefore, the value of the currency generally goes down, right? So that's just the interest rate parity. You can basically predict that the bull market in US dollars sort of, just from a trading perspective, not from a fundamental perspective, is going down in the short term, because of the fact that we're leading the way in the Western world in terms of interest rate cuts. And that has, again, secondary, tertiary impacts in commodity prices, oil, gas, these things that are heavily involved also in the wars that are happening around the globe. So yeah, a lot of implications that we're not going to dive into, but I encourage folks to really spend some time digesting the information.
Very cool. Pleasure as always. Thank you so much, Chris.
Of course. Have a good one. Talk to you soon, Mark.
A quick reminder for everybody, Chris is an SEC registered RIA. Nothing he said today should be misconstrued as investment advice. All right, everyone. As always, Chris is coming in hot. At least it wasn't bad news. The market's up in a lot of ways, but complexities abound. I'm looking forward to talking to him in a future episode, not quite yet, about what's going to happen as a byproduct of the new president in Argentina. That guy's just getting started up, and I have a feeling that's going to drive more demand for the dollar, and there might be some interesting implications. So more to come, lots more to dig into. I hope you're well, and we'll catch you next week.